For more on the UK's economy, here's Remi Piet. He's senior partner at Embellie Advisory. Good to see you again, Remi. And you know, in the UK, much like the US, we seem to be in somewhat of a lockstep. And you know, we had our 75 basis points. They had their 50, and a lot of people would ask, well, why not they do the 75 and so on. But I mean, the two economies, while there are similarities, that they are very different, aren't they?
Well, they are obviously in terms of their respective, relationship and potential commercial exports and balance of power here. And there's a series of different elements that are differing from the United States and the UK. But in the case of the UK, really here, the rate increase of the rate was warranted. 0.5% was actually lower than potentially some other expectation. And clearly, the Bank of England mentioned that it might actually increase again. It's likely to increase again before the end of the year. Britain has been facing the highest level of inflation into what former eurozone, or at least the European Union plus Britain, much higher in terms of 3 points higher than France, for example. And it was very important to be able to clearly try to quench this inflation. That obviously the reactions to it from the market were negative. But when you look at the relation between the US and the United Kingdom, the British pound had already lost 15% of its value over the last year. So it was important to try to responsibilize the economy, especially ahead of a potential tax cut plan from Liz Truss that is expecting to
right.
fairly soon.
So, I look at it like this when we talk about inflation. It's like I have, say, 5 apples and you want to buy 6 apples. So I'm going to sell you the 5 apples for more money. So either we can destroy the demand that you want to buy something, or we can increase the supply of things available to you. And by raising rates, you do destroy demand, right? So that's fine. But you also hurt the fact that I'm not going to make more stuff if it's so expensive. I'm not going to invest in manufacturing or in production. And this argument has to be said, that is raising rates the right solution to fixing a problem which sort of was half created by COVID and all the ridiculous policies of giving away money, and now we're trying to reverse all that. And I don't know what you think, but is England capable of fixing it? And maybe that question goes for many countries in the world.
I mean, you're making a very good point in terms of the impact that it will have on the availability of capitals for future investment. The big losers in this moves are actually the one that we're about to borrow to build new investment, or people that actually are in debt today that might see the interest of their own debt, credit card debts and others increase. But that was actually really warranted in terms of a move to actually try to cool down the British economy and trying to strengthen the British pounds, and therefore being able to also have an impact on future energy prices by reducing the cost of imports by strengthening the British pounds. But indeed, the question here is, what is the plan ahead in terms of addressing the real cause for inflation after COVID? Obviously, the kind of really monetary easing to bring a strengthening of the global economy after COVID was maybe a little bit overstated and too much, and the reaction was more inflation. At the same time, right now, it's really the current invasion of Ukraine and impact on energy prices that is further increasing these. I mean, and then obviously those are the real cause for the inflation. But there needs to be some kind of responsible answer from the central bank. That's what they did in terms of increasing interest rate to actually reduce the level of inflation that actually could have scrambled.
Okay, so they raised it by 50 basis points. Yes. I think we get that. One thing I somewhat understand, but why is inflation so much worse in the UK versus the rest of the Eurozone? And I don't want to single out any particular country, but it is worse. And you can't help but think, did Brexit perhaps have an impact on that? I don't know the answer.
So it absolutely has. I mean, there's several reasons, obviously, for the stronger inflation in the UK. But definitely one is the impact of Brexit on the capacity of companies to address access to their traditional markets. A series of mismanagement also from the Boris Johnson administration in just giving away a series of measures and populistic measures that were not probably warranted and not well targeted specifically on this. There's also the fact that markets are actually not confident in the future of the UK in comparison with other countries that have made the necessary reforms. Counterintuitively, right now, as I said, the reforms prior to the current Ukraine crisis of markets and investment, I made France and Germany much more attractive to foreign investment than the UK. So all these elements together, obviously, have made a weaker British economy compared to the other countries, and a stronger inflation there. And that made it even more necessary for this rise of interest rates.
Right.
That will be leading to a likely recession. We're talking about recession already in the third quarter here of the economy. The job market is still fairly tight tight in terms of having low level of unemployment, but we will be looking at inflation. It's a necessary evil in front of the current crisis on so many fronts, especially the current inflation.
It's so weird that we have to have a recession to solve the inflation problem, which means more pain to relieve the pain. There's a lot to go into. We're out of time, Remi. One of our favorite people to talk to about this topic. It's good to see you, my friend.
It's my pleasure, Phil.